Why all millionaires follow a value investing rule. Some of the best known billionaire investors follow one common approach. They are value investors. They know markets aren't always efficient. Value investing rejects the idea that securities are properly priced and markets are efficient. One area where this inefficiency occurs is when unprofitable companies are highly valued. That's based on hopes of future profitability, rather than securities analysis. They seek intrinsic value. A company's intrinsic value is calculated through fundamental analysis and not market value. They also look for companies that can grow over time, which can confuse some investors who think value investing precludes growth. Value investing is not get-rich-quick growth. The best of both worlds is to buy a company that is growing, but with share trading at a discount to its fundamental value. They seek a margin of safety. Investors who employ a margin of safety tend to only purchase securities when the market price is greatly below the intrinsic value to minimize risk of loss. Investors can use margin of safety based on their risk preferences, and it can be applied to any type of investment. They know their circle of competence. A circle of competence is the subject area in which the investor has some skills or expertise, and it builds on the idea that investors should buy what they know. We don't have to invest in everything. Investors can limit their risk by concentrating on investing in industries they understand. They look for companies with wide moat. If you own a basket of securities that have strong competitive advantages, that are consistently reinvesting in their capital into research and development to further competitive advantages, and you have a good management team or a corporate board, that stock over time should reward you because of growth of the business. They're patient. When investors have done their research and found a company with a strong balance sheet and good management with stock trading at a discount, these investors focus on the long term and won't get distracted by market volatility. Value investing at its core is a way to remove emotion and make fundamentally sound decisions. They buy at the right time. Patience is not just buying and holding, but waiting for the right time to buy and not overpay. Many of the top value investors have done their research on a company, a plan of when to buy and a disciplined plan to follow. The hardest thing for investors to do is to sit on your wallet. But when markets retreat, you're prepared to react to take advantage of falling prices. They don't time the market. Timing the market is nearly impossible to do correctly. Focus on the idea of time in the market, not market timing. You don't look at the value of a farm every year. You just make sure that it's yielding what it should be. There are years when it yields more or less, but over time, the farm's value should increase.